Good morning, dear students. Morning, everyone.
Good morning, sir.
Morning. So, Monday morning. So, we have started with the security valuation, and if I'm not wrong, we have covered quite a good part for equity valuation, right? So, let me just quickly run through what we have discussed till now, and then we will just take it forward. So, we were obviously looking for valuation, and what was the purpose of valuation? It helped us to determine whether we making an investment or we should not be making an investment, right? Now, whether an investment will be made or not, that was actually dependent on valuation of the security, right? And we were interested in knowing whether a particular security is overvalued or undervalued. Okay. So when you want to look at whether a security is overvalued or undervalued, the decision was to will be buying if a security is undervalued, whereas if a particular security is overvalued, our action is supposed to be to sell it, right? Then we continued with the concept of return. So we said what should be the required rate of return? That should be ideally the opportunity cost of capital. Discount rate, it's the rate that we use to calculate the present value of the future cash flows. And of course, it depends on the risk. So higher level of risk requires higher level of discounting. Okay, then we had already known what's an IRR, the rate of return that an investor earns from the investment. Whereas the required return on equity, it depends on the risk. And a classic case of calculating return on equity was CAPM, wherein we simply said that the return that we want, it depends on the level of systematic risk that an equity has. Then when we are valuing the equity shares, we wanted to obviously take the present value of the cash flow. So one way of looking at it is, if the holding period is just 1 year, you just take the present value of one dividend that you're going to receive and the price. Similarly, if you have holding period is for multiple holding period, or where you don't know for what time period the holding period is going to be there, so we said it's going to be held for, let's say, perpetuity. And then in that case, if you say that there is no growth, then the value of the share was dividend upon KE. If there is a constant growth, if there's a constant growth till perpetuity, then we said we can use the Gordon's formula, which is D1 upon KE minus G. And then we said that if this Gordon formula has got some issue, is that growth rate can't be more than the K. And if it turns out to be more than K, then the answer comes out to be negative, which is quite weird, right? So therefore, we said let's go for understanding in a better way, wherein we said that high growth rate can't be actually maintained for a longer tenure. So it's better to just assume that the high growth will be attained for a certain number of years, and then beyond that, there will be a stable growth rate. So we use a two-stage dividend discount model, right? So we've done a couple of questions on that. And then we went ahead with the concept of earnings-based model, wherein we had the Gordon model, but we just revised it with regards to the EPS, then the Walter and the P multiple model. Post that, we have also learned how to calculate the free cash flow, right? So free cash flow for the firm and free cash flow for the equity. So free cash flow for the firm, we can start with net income, just add back the post-tax interest and the depreciation, adjust for capital expenditure and the working capital expenditure. Free cash flow for equity is basically removing that debt component and from the FCFF, so which involves FCFF minus the post-tax interest, minus the principal repaid, minus the preference dividend, and also any additional new debt raised. Or you can also say that both principal repaid and new debt, it would be the net debt raised. Okay, so we've done one of the questions based on that. Now let's just go ahead with maybe do a couple of more questions on this, and then we can take it forward for the relative valuation models also. Okay, so right now let's just have a look at the next question. Yeah. So the next question that we are going to have I think the last question that we did. It was, what was the last question that we did?
Question number 6.
Question 10.
Yeah,
I think it was 10.
we did question 10, right? Yeah. Yeah, question 10 was done. Now, next question, which is on the similar lines.
Sir, in the dividend growth model, we have done two stage model steps. Okay, is it possible for the three-step model, three-stage
Yeah, you
growth?
can also have three-stage model, definitely. You can definitely have a three-stage model also.
Yes, sir. Could you please solve any one of the questions?
Yeah, we'll give you an example for that. Don't worry. Sixth is done. Then we have 8, 9, 10, 10th, 11th, and I think. We will be doing three-stage model, don't worry. So even that model is applicable for FCFF and all things also. So combined way, we will be definitely taking up that.
Okay, sir.
Okay, so don't worry about that. This is per share is given. I don't know, this is asset turnover. Sustainable growth. I'm searching for a question. Anyways, let's just do one question that we are left out with here. Let's go ahead with question number 2 right now. Okay. So here we look at this question. It's not that FCFF or FCFE thing, but it's a totally different question that we are currently looking at. Okay. So let's say ABC Limited's shares are currently selling at a price of 13. So we have the information with regards to the current market price. So essentially what we have is current market price is 13 rupee. There are 10 lakh shares outstanding, right? So existing number of equity shares. So existing number of equity shares is 10 lakh. The firm is planning to raise 20 lakhs to finance a new project. So essentially we need one additional funding of 20 lakh. So we want the funds required to be rupees 20 lakhs. So this is the additional funds that we need to raise. Now required, we want to know what will be the X rights price of the share and the value of a right if the firm offers one for every two shares, and if the firm offers one right share for every four shares held. Now, how does the shareholder's wealth, which is a shareholder who is holding 100 shares, change from 1 to 2? And how does rights issue increase the shareholder's wealth? Okay, so let's look at the first case, wherein we are issuing rights issue of one share for every two shares. Okay, so we're saying rights issue of one share for every two share. Okay. Now, if this is the case that you are going to issue one share for every two share, we need to first get what will be the number of right shares to be issued, right? So we'll say number of rights shares to be issued. Number of right shares to be issued. So number of right shares is basically 10 lakh
divided by 2.
divided by 2. So we will be issuing 5
5
lakh,
lakh share.
right? So can you tell me what will be the price of the right shares?
4 rupees.
Price of the right shares. What is the total funds required? That is rupees 20 lakh.
20 lakhs. 20 lakhs means divided by 5 lakh shares till 4
So
rupees per
20
share.
lakhs divided by 5 lakh, that is going to be 4 rupee. So you're going to get 4 rupee as the price of the right shares. Okay. The question asks us what will be the X rights price of the share and the value of the right. Now, how do we calculate the X rights price? X rights price of share. So what will be the X rights price of share? Obviously, we say originally we had 10 lakh shares for a price of rupees 13. Right, so this was the wealth of the company before rights issue. Now the wealth of the company increases by the amount of money that it raises through rights issue, which is 5 lakh into 4. And now this total worth of the company is going to be divided by 10 lakh plus 5 lakh. It's going to be 10 lakh plus 5 lakh. So total 15 lakh shares. So now what will be the theoretical X rights price, guys?
10 rupees per share.
10 rupee. Right, that's the X rights price which we have. So 10 rupees is the X rights price. Now what will be the value of right? Value of right. So value of right is basically you are going to pay 4 for getting a share which is worth 10 rupees. So the value of right is simply going to be 10 minus 4, which is 6 rupees. Okay. So we have got the X rights price of the share and the value of a right. Okay. So each of the right is having a value of 6 rupee. Okay. And the theoretical X rights price is 10. Now similarly, we have got a second case wherein we have the rights issue of one share for every 4 shares. Now, one share for every 4 shares. Over here, can you tell me what will be the X rights price? I want you to calculate this part. Give me the X rights price and also the value of the right. Give me the X rights price and the value of the right. Give me the X rights price and the value of the right. Yeah, guys. Tell me what will be the X rights price and the value of right if it is one share for every 4 shares. Do the same calculation that we did in the first part and get the answer for the second part, guys.
So X rates price is 12 per share.
X rights price is
12 per share.
12 per
12,
share.
sorry.
Okay,
Yeah.
perfect.
And value of rights is 4.
Value of right is 4. Okay, everyone got it?
Yes.
Yeah. Okay, now the next part of the question says, how does the shareholder's wealth, I mean the shareholder who is holding 100 shares, change from 1 to 2, and how does the rights issue increase the shareholder's wealth? Okay, so let's go for the third part. Calculation of effect of rights. Calculation of effect of rights on wealth of investor. Calculation of effect of rights on wealth of investor. One right for 2 shares. That's the first case. So in this situation, we would like to know what is the wealth of the investor or wealth of the shareholder before rights. So wealth of, let's say they've given us some number, let's say 100 shares. Okay. Wealth of investor before rights issue. Can I say the investor was having 100 shares into 13, which is 1300. The wealth of investor before rights, it is 1300. Now, of course, how many right shares will be offered to him? Number of right shares offered?
2. 2 means
Since it is 1 for every 2, it will be 100 divided by 2, which is 50 rights,
50.
right? So now here, if we have, let increase how does the shareholders' wealth holding 100 change from 1 to 2, and how does the rights issue increase the shareholders' wealth? Okay, so we'll see whether there is a change in any shareholders' wealth. So now, since it is, what will be the amount paid for rights issue? Amount paid for rights
200.
issue 50 into 4, right?
200.
So 200. 50 into 4, which is 200. Now, post rights issue wealth of shareholder. Post rights wealth of investor, we will say now the total shares that the investor is having is 100 plus 50, which is 150, into X rights price of the share is 10. So 100 plus 50, that multiplied by 10, right? So this is like 1500, right? But this is not entirely what your wealth is, because you have actually paid some amount. You have paid this 200. So that's not what your, this 1500 is not your wealth, because if after paying 200, your wealth increases by 200, so your wealth has actually remained same, right? So since you've paid out 200, your net wealth still remains 1300. Okay. And then if you look at the second case where you're issuing one right for 4 shares. So if you're having one right for 4 shares, we'll talk of what is the wealth post rights. So wealth post rights will be 100 shares plus how many shares do we have? I mean, as rights issue?
25.
25. So this multiplied by, what is the price? Theoretical X rights price? 12, right? Into 12.
Yes, yes.
And
Sir.
obviously you are paying how much to get this rights? 200? Because it is value of right, X rights, what's the price that you're saying? X rights price is 12 and value of right is 4. And if it is, okay, what are the price of rights over here, guys?
It's 8, sir. 8.
Price of right shares that I didn't write here.
8.
How much?
8.
8. 8. So, okay, so this is going to be multiplied by theoretical X rights price minus into 12. And this 200, minus what is the price? We are going to get how many shares? One right for every share. So 25 shares at a price of 8. So you can see that the wealth of shareholder doesn't change whether it goes for the first option or for the second option, because ultimately what you're paying is what you're getting back in the form of the shares. Right? It's not that you're paying 1 rupee and you're receiving back a share which is worth more than 1 rupee. So there is this disparity always. So we have that one right for every 4 shares as wealth post rights is 1300. So net wealth that we have post rights is 1300. Okay. Fine. So I think that is question number 2. So question 2. This is done, guys. Right? Okay, so 1, 2, 3 is done. Yeah, let's go for 4th one now. Question 4. On the basis of following information, current dividend current dividend D0 is 2.5. Dividend rate is 10.5%. Growth rate is 2%. Okay. So we have the dividend value, we have the discount rate, which is the cost of capital, and also the growth rate is 2%. We have to calculate the present value of the stock of ABC Limited. Is its stock overvalued? And if the stock is, let's say 35, you have to say whether it is overvalued. Return on equity is 9%, EPS is 2.25, and we have to do the detailed calculations using P multiple and earnings growth model. So you have to use both things, P multiple and earnings growth model. So there are two aspects to it. So let me just take down this question over there. Okay. So with regards to the first question, the first part of the question, can we calculate the present value of stock of ABC? So P0 is equal to, we know it is D1 upon K minus G. Right? It is simply D1 upon K minus G. Now how do I get the D1? D1 is basically D0 into 1 plus G upon K is to be given. I mean, K is already given to us. So if I just substitute over here, it is 2.5 into 1.02 upon 0.105 minus 0.02. So what is this value?
₹30.
How much?
30.
30. So price is 30. That's for the first part of the question. Now second part says if the stock is it stock overvalued if the stock price is 35 and EPS is 2.25. So we have the market price of share as 35. Return on equity is 9%. EPS is 2.25. Okay, so we have to calculate the value using P multiple approach and earnings growth model also. So first let us talk of P multiple approach. So using P multiple, now using the P multiple, we have the earnings per share as 2.25. Earnings per share is given as 2.25, right? And now how do I know what is the P that is applicable? So for that I'll have to take help of return on equity. So return on equity is 9%, right? So return on equity is 9%. So this implies that our price to earning ratio is simply 1 divided by return on equity. Okay. So price earning ratio will be 1 upon return on equity, simple. Because return on equity is what you get as EPS upon MPS. And we know P is what? MPS upon EPS. So they are just reciprocal of each other. So P multiple is 1 upon return on equity. So 1 divided by 0.09. How much is this number, guys? 1 divided by 0.09.
11.11.
11.11. Okay. 11.11. So MPS using P approach, that is 2.25 into 11.11. 2.25 into 11.11. So how much is it going to be? Two point two five.
25.
11.
25.
25.
5.
So value of the share is it's 25, but in the market price it is 35. So actual market price per share is 35. So therefore, can I say share is overvalued if I go by this P multiple approach. Okay, and then the second part is to also check for earnings growth model. Okay, earnings growth model. So in this earnings growth model, EPS is 2.25. So I need to first get the growth rate over here, right? So for regards to the growth rate, we just when we look at the earnings growth model, it is nothing but P0, just as we have the dividend thing. It's going to be EPS 1 upon KE minus G. So EPS is anyways 2.25 into 1.02, because the growth rate is already given to us as 2%, so I have to accept it as it is. So if we're just copying this particular growth rate. So EPS is 2.25 into 1.02 divided by KE is 0.09 minus 0.02. So how much is this number, guys? Price earnings growth model, EPS 1 upon KE minus G. How much is this
36,
number?
36.43.
36.43. Is it?
Comes to 32.79.
32.79.
79.
Okay. So it should be 2.25 into 1.02, and then you divide by 0.07. Yeah, 32.79. So using this approach also, can I say this is less than the market price per share of 35. Of course, here also we can say that under this approach also the share is overvalued. Got it, everyone?
Yes, sir.
Yes.
Yeah. Okay. Now, yeah, now since you were just saying that we want to look at the 3-stage model, so let's go for the 3-stage discussion. So I think question 4 is done, 5th is already done, 6th is done. Yes, 7th again it involves some other calculations, so we'll take up that. Now let us first focus on that 3-stage cash flow model, which will be obviously applicable in case of dividend also. Okay, so let's discuss about that part. 3-stage cash flow model. Okay, so why is the need for 3-stage cash flow model, by the way? Because the situation is like, sometimes what we observe is that you give us some dividend which is ongoing right now, let's say 20 rupees. Okay, and we talk of the growth rate. We talk of the growth rate. So growth rate, we say that there will be a high growth phase, let's say 30% from year 1 to year 4. Let's say for 4 years, you're going to have a high growth rate of 30%. Okay. Now, this high growth rate of 30% from year 1 to year 4 is going to be there. But do you think it's actually sensible to say that from next year onwards, directly the growth rate falls from 30 to 10. Do you think it is making any sense for us to say it that way?
No, sir.
Can we say that it's going for now? If you do it like from, this is from year 5 onwards. If this is from year 5 onwards, so 30% is from year 1 to year 4. 10% is from year 5 onwards. Okay, 10% is from year 5 onwards. So if you look at what is a growth rate happening, and I just try to plot it by way of a chart. Okay, so if we have, let's say like this, 5, 10, 15, 20, 25, 30. Okay, now these are the number of years, let's say 1, 2, 3, 4, 5, 6. So what you're saying is that the growth rate, remains 30% for up to year 4. And then you say that suddenly the growth rate drops from 5th year onwards. It drops suddenly to 10% in one particular year. And then it just continues like this. Does it really seem to be appealing to you that it's going to be like, you're going to have high growth rate for a certain number of years and then suddenly the growth rate falls to 10%? Does it seem appealing to you or something, absurd? It appears to be something absurd, right? Because how can it be a case that in one particular year there's a drastic fall in the growth rate? It's not going to be that way, right? So the more accurate way of, because when you're saying this, you're talking of like year and the growth rate. So year 1, 2, 3, 4, 5, 6, 7. So growth rate is like growth rate is like 30% for first year, second year also, third year also, fourth year also, and then from 5th year you suddenly have like 10%. So this is something which is difficult to interpret and also not so easy to assimilate. So a more accurate and appealing appealing way of looking at this growth rate is to say that it's not going to fall directly from 30 to 10. After, okay, you have a high growth rate for certain phase, and then gradually there's going to be a fall, right? So we can actually say that when we're looking at gradual decrease, right, gradual decrease in growth rate, gradual decrease in growth rate. So we can say year and the growth rates. So year 1, 2, 3, 4. Okay, you got a high growth rate of, let's say, 30%. But I say that the long-term growth rate is 10%. Okay, but that is going to happen like year and growth. When I say year 1 to 4, we say it's going to be 30%. And then from year 5 onwards, there will be a transition phase. Okay, and so this is basically from 5 to 9. 5 to 9, there's going to be a transition phase, or yeah, and then year 9 onwards, it's going to be 10%. So from year 9 onwards, it's going to be 10%. So for year 4, 5, 6, 7, 8, 9 onwards, 10. So there has to be a gradual fall. So like year 9, it's going to be 10%, and beyond that, it's going to be now 10%. So gradual fall has to be like from 30 to 10 over this time frame. So over this time frame, we want the growth rates to be falling from 30 to 10. We want the growth rates to be falling from 30% to 10%, right? So can you tell me what should be the growth rate in year 5, 6, 7, and 8? So it should fall from 30 to 10% from year 4 to year 9. So by what should be the growth rates over here so that it appears to be a gradual fall?
Between 29 to 11.
But if I want to say that there is a gradual and a prominent, easier fall in the growth rate, does it seem like we can have it like from 30? Let's say fifth year it falls to 26%, then it falls to 22, then it falls to 18, then it falls to 14, and then finally to 10%. Right?
Yes.
Correct. So the gradual fall that is happening, right? That's what we want to know. So you can say fall in or reduction in growth rate per annum in transition phase. Right? So reduction in the growth rate per annum during the transition phase, we can actually calculate it by a simple method. We say high growth minus the low growth number divided by low growth year minus high growth year. So basically high growth is 30% minus low growth is 10% upon high growth year. Sorry, low growth year is happening to be from 9 years and this is from 4. So you can say every year 20 divided by 5, there is a 4% fall in the growth rate. There's a 4% fall in the growth rate. Makes sense, guys? Okay, so you can see that we have reduced the growth rate every year by 4%. And then obviously, if I just try to plot this will be appearing to be more, accurate and also visually appealing. Or I'll just copy this one to make it more. Okay. So it's like we are not saying that we are going to just stop our calculations here. Rather, this just goes extended from 6, 7, 8, 9, and 10. Now, we can see from 9th year onwards, the growth rate falls to 10%. So here, in this phase, what we observe is there is a slow transition from 20% to 10%. Now, this seems, something more accurate, wherein we can definitely say that the growth rates are falling, but it's not a sudden fall. It's going to be a fall which is what we say as, a slower and a gradual fall. Okay. So now with this same example, let's try to value the particular share. Okay. We'll take this case where we have the growth rate and the dividend. So let us say we have got the years, growth rate, particulars, then we have the cash flows, PV factor, and PV. So we have year 1, 2, 3, 4, 5, 6, 7, 8. Okay. Now the growth rates we have like 30% for first year, 30% for second, 30 for third, 30 for fourth, and then there is a fall. So you have 26%, 22%, 18%, 14%, and we know obviously that in the ninth year the growth rate is going to be now 10%. Okay, so particulars we're going to have the dividend in first year, dividend in second, dividend in third year, dividend in fourth, dividend in fifth, dividend in sixth, dividend in seventh, dividend in eighth year, and also in eighth year we need to get the terminal value V8. Okay, so first let's try to calculate what is the terminal value over here. Okay, so value in year 8, we'll do it below it, just 8. Can you tell me how do we get the value of the share in year 8?
D9.
D9 upon K minus G. Achha, for that, we need to get D8. So D8 into 1.1 upon what was the cost of equity that we said? Okay, we didn't specify the cost of equity. Let's take it as 15%. Okay. So 0.15 minus 0.1. So we need to first get the D8 values. So here we have this cash flows. So the first dividend that we will have is, giving 30% hike. So 20 into 1.3, which is 26. Same way, can you calculate all these cash flows? Then also value of the share in year 8 by substituting this. Take the PV factors at 15% and then total of PV. Can we do this? Yeah. Can we do the calculations, guys? Yeah. Just confirm, guys.
Yes.
Yes. Okay.
Yes, sir.
Yeah, easy. So just do the calculation. Take the PV at 15%. Give me the total of PV. First, you give me. Okay. You solve it fully. Then I'll discuss it. Okay. Solve it fully.
Sir, what is the KE, sir?
15%.
10%.
15%. KE is 15%.
So it comes to 1110.52.
Okay, 1110.52. Okay, just let me know with the dividend. What's the second day dividend? 33.8. Then
3.8.
43.94. 57.12.
Okay, perfect. Then
71.9.
71.97.
okay, then
87.81.
87.81. Perfect. Then
103.61.
103.61. Okay,
118.12.
18.12. Now, of course, this will be 118.12 into 1.1 divided by 0.15 minus 0.1. So, what's the value of the share in year 8?
2,598 rupees 64.
2,598.
64.
So, this is 2598.62. We have the present value factors, and then we take the PV. So, as you said, is it coming out to be 1110.52, right?
Yeah.
Okay, everyone. So that's the three-stage discount model. So you can use this for any sort of cash flows, be it dividend or be it free cash flows also. Okay. Now, let's go ahead with the next concept, which we call as the enterprise value. Enterprise value. Just a moment, please.
So I have one clarity on the three-stage model. So the thing is that we need to continue to calculate the present value of that growth until the third stage constant growth is begin.
Yeah, until you have the stable growth rate coming in.
Okay, that is a logic here.
Yeah. Sorry.
Yeah, that is a basic logic here.
Yeah. Because until you have a stable growth rate, I cannot apply the Gordon model, right?
Okay.
So to reach up to that Gordon level, whatever cash flow you have in between, you just need to take the PV of it.
Okay, sir. You really very well explained the concept of that diagram.
Thank you. Thank you so much. Okay, so let's go ahead with the enterprise value, guys. So enterprise value is what we mean by value of the business, or to be put it other way around, we can say it is representing value of all businesses of an organization. Value of all businesses of an organization. So enterprise value is simply value of all the businesses that we have of an organization. Okay, so EV or enterprise value is simply said to be, market value of all shares plus market value of all debts. Okay, and then you subtract the cash. Okay, so market value of all shares plus market value of all debt minus cash. So we have EV multiples which we are going to use, right? EV multiples to be used. Now, what do you mean by EV multiples? See, enterprise value in relation to something, like enterprise value with relation to the EBITDA, with relation to sales. It could be with relation to the profit that we have. So such way we can have enterprise value as multiples which will be used for evaluating the companies, right? So we may have various multiple values, like let's say we've got two companies X and Y. Okay, so there we find their numbers of EBITDA and their enterprise values. So EBITDA of X is, let's say, 1,000, and the enterprise value is, let's say, 10,000. Y, company Y has got an EBITDA of, let's say, 960, and the enterprise value is 8,500. So can you tell me how much is the EV to EBITDA multiple? I hope we know what is EBITDA. Everyone, are we aware what is an EBITDA?
Yes, sir.
What is EBITDA? Can you spell the full form?
Earning before interest, tax, depreciation.
Earnings before interest, tax, depreciation, and
Depreciation and
Amortization, sir.
Right. So this EV to EBITDA over here, it comes out to be 10, and in the second case it is 8,500 divided by 960. That's 8.85. Right. So this particular number 10, this indicates for every rupee 1 of EBITDA, for every rupee 1 of EBITDA, enterprise value is 10. Right? And in the second case, of course, it is for every 1 rupee of EBITDA, the enterprise value is 8.85. Now, let's say I want to value another company, let's say Z, with an EBITDA of 150. Right? What should be the EV EBITDA I should take? Of course, take a average of both of them. Right? So let's say average EV EBITDA multiple 10 plus 8.85 by 2. So that is 10 plus 8.85 divided by 2, which is 9.425. So 9.425, that's the average EV EBITDA multiple. So we can apply the EV EBITDA here, 9.425. So essentially this enterprise value of this company can be determined as 150 into 9.425. Right? So by using the average function, we can say 150 into 9.425. So we can calculate the enterprise value of this company as 1413.75. Got it, everyone? Easy?
Yes, sir. Yes,
How do
sir.
we
Easy.
calculate the enterprise value? It's pretty simple. You just need to take the average of the things. Okay. Now, let us go for maybe the remaining questions on. Yeah, so we'll go ahead with the remaining questions that we have. Question number 7 is pending, right? Question number 7. Let's do this simple question of question 8 first. Yeah. Let's take up this question number 8. Okay, let's look at this. ABC has been maintaining a growth rate of 10% in the dividends. Okay, the company has paid a dividend at rupees 3 per share. The rate of return on market portfolio is 12%, and the risk-free rate of return in the market has been observed as 8%. The beta coefficient is 1.5. You are required to calculate the expected rate of return on company shares as per CAPM model and equilibrium price per share by dividend growth model. Okay, so we have ABC has been maintaining a growth rate of 10% in dividends. So we have the growth rate as 10% given to us. Company has paid a dividend of rupees 3 per share. So what is this 3? Company has paid a dividend of rupees 3 per share. So can I spell this D0? The rate of return on market portfolio. So we have RM as 12% and RF as 8%. You have the beta coefficient as 1.5. So first we need to calculate the return on equity, right? And then after that, we have to calculate the price. So KE will be RF plus beta into RM minus RF. So RF is 8% plus beta is 1.5 to 12% minus 8%. So what is this? How much is this KE, guys?
14%.
Sorry, 15%.
14.
Okay, 14%. Now, obviously, we can get the price as what? D1 upon A minus G. So D1 will be 3 into 1.1 upon KE is 14% minus growth rate is 10%. So this is 3.3 upon 0.04. So P0 is 3.3 upon 0.04. How much is the number? Price?
82.5.
82.5. Perfect. Okay. That's pretty easy. So that's question 8. Now, let's look at this question 7, guys. Yeah. Okay. This is the question number 7, I think. Yeah, that's question 7. Okay. So capital structure of Sun Limited as on 31st March 2003 is as under. So we have equity share capital. Equity share capital is 80. Preference share capital is 40. 12% debentures is 64 and reserves is 32. So Sun Limited earns a profit of 32 lakhs annually on an average before deduction of income tax, which works out to be 35%, and interest on debentures. Normal return on equity shares of companies similarly placed is 9.6%, provided. Now there are certain conditions which are attached with the return of equity being fixed at 9.6%. So profit after tax covers fixed interest and fixed dividends at least 3 times. Capital gearing ratio is 0.75. So these are the two conditions. And yield on share is going to be calculated as what? 50% of profits distributed and 5% of undistributed profits. Now, Sun Limited has been regularly paying equity dividend of 8%. You have to compute the value per equity share of the company, assuming 1% for every one-time difference in interest and fixed dividend coverage ratio. So if you have this fixed dividend coverage ratio being breached, which is stated to be 3 times, for every one-time difference, 1% is extra premium that you add. And same way for capital gearing ratio, for it's every one-time difference, you need to add 2%. And we have to compute the value of the equity share. Now, so of course, to get the value of the equity share, I need to calculate, the yield and the required return. I mean, what's the actual return and what's the required return. So first, let us compute over here the profit after tax that we are generating. Okay, so let's go ahead with the first part, which is calculation of profit after tax. Now, how do we compute the profit after tax? We have a profit of 32 lakhs annually on an average before deduction of interest, before deduction of income tax, interest, and the debentures, interest on debentures. So we'll start with this 32 lakhs. What is this 32 lakh denoting? What type of profit is this? Can anyone identify?
PBIT.
Profit before tax and depreciation. EBITDA.
That is EBIT. Perfect. So we have EBIT of 32 lakhs. Okay. So EBIT is 32 lakhs, profit of 32 lakhs annually on an average. And now from that, of course, we are going to deduct the income tax, which works out to be 35%, and also interest on the debentures. So from EBIT, we will be subtracting the interest, which will give us profit before tax. Right. Further, we'll subtract the taxes, which will give us profit after tax. Then we subtract the preference dividend. So we get net profit for equity shareholders. Okay. Less equity dividend, which will give us the amount which is transferred to reserves. Okay. From 32 lakh, what's the interest that we are going to subtract? From 32 lakh, what is the interest that is going to be subtracted?
7,68,000.
12% of 64, right? So 7 lakh
68,000.
7,68,000. Then profit before tax
24,32,000.
24,32,000. What's the tax rate?
35%.
35%. Yes. So at 35%, the tax rate will work out to be how much?
8,51,200.
8,51,200. Okay. So after that, what is the profit after tax left?
15,80,800.
Okay, 15,80,800.
800.
Then the preference dividend will be 8% of 40, which is
3,20,000.
3,20,000. Okay. Net profit for equity shareholders 15 lakh
12,60,800.
How much?
12,60,800.
Okay, 12,60,800. What's the amount of equity dividend we are paying out?
80 lakhs.
Any equity dividend given?
It's given 8% regularly pay.
Mm-hmm. 8%. Yeah, it is paying equity dividend of 8%. Now, this is obviously going to be equity dividend when you say it's of 8%. This is going to be 8% of what? Of the face value.
180.
So
80
equity
lakhs.
dividend will be 8%
6
of
lakh
face
40,000.
value. So 80 into 8%, which is
6 lakh 40,000.
6,40,000. And this goes as a transfer to reserves, which is
6 lakhs 20,800.
6,20,800. That's the amount which is transferred to reserves. Okay. Now, we need to check what is the required return, because they're saying that normal return on equity shares of company similarly placed is 9.6%. So normal return on equity shares of company similarly placed is going to be 9.6%. Similar companies have got a return on equity as 9.6%. But of course, I need to add these premiums. So for that, we need to first compute these ratios, interest and fixed dividend coverage, and also capital gearing ratios. So let us first compute these ratios, guys. Interest and preference dividend coverage. How can we calculate this interest and preference dividend coverage? What should be the formula that I should use? Well, I need to check what is the preference dividend and interest coverage, right? So we'll talk of interest plus preference dividend being the denominator, and we want to know how much funds do we have to pay this in the numerator. So in the numerator,
Preference share capital plus debentures.
no, not preference share
EBIT.
capital. I need to know what is the amount of profit or earnings or cash flow that I have to pay interest and preference dividend. So for that, we do it like this. PAT, if I would have done simply PAT upon preference dividend, if I want to check whether I'm capable to pay the preference dividend or not. But I need to also see whether I'm going to pay interest or not. So for that, I'll have to add here interest into 1 minus T. So this is essentially like PAT. That's the PAT profit that you have. But you add back the interest over here, because in the denominator, you are checking whether you are able to pay the interest or not. Okay. So we just say that PAT is 15 lakh 80,800, plus you add back the interest to it, which is 7 lakh 68,000, make it post tax, and this is the amount that you have to pay interest and preference dividend. So you have to pay interest of 7 lakh 68,000 and a preference dividend of 3 lakh 20,000. So what is this value? What is this number, guys? Interest and preference dividend coverage. Yep. What's the number?
1.91.
1.91.
91.
1.91 times. And what was the threshold? What was the target that they had? What was the ideal number?
3 times.
At least 3 times. Right? But here it is 1.91, right? So do we need to add some risk premium due to lower coverage? Yes. So what will be the risk premium due to lower preference dividend coverage? So risk premium due to lower preference dividend coverage, this is going to be equal to risk premium due to lower preference dividend coverage. This is going to be equal to 3 minus
1.91.
1.91, because this is the deficit that we have. And for every 1 times, what is the risk premium that we have? 1%. So this is how much? 1.09%. Risk premium due to lower preference dividend coverage is going to be 1.09%. Okay. Capital gearing ratio.
How did we get this 1%?
It's given in the question, right? See, 1% is the
Yes.
premium for every 1-time difference of interest and preference dividend coverage ratio.
Right. Okay.
Got it? Now, let's look at the capital gearing ratio. Capital gearing ratio we calculate as preference share capital plus debt upon equity share capital plus reserves. Okay. So what's the preference share capital given in the question? 40, and debentures is 64. Upon equity share capital plus reserves is 80 and 32. So that's 40 plus 64, which is 104, divided by 80 plus 32, which is 112. Right? So capital gearing ratio is what? 0.93.
93.
What is the target that was given to us? Capital gearing ratio is 0.75.
75.
75. Of course, it's more than that, right? So what will be the risk premium due to higher capital gearing ratio? So due to higher capital gearing ratio, what will be the risk premium? 0.93 minus
75.
0.75 into
2%.
2%. Okay. So how much is this? 0.93 minus 0.75 into 2%?
0.36.
0.36. So that's the risk premium, 0.36. Right? So what will be the required return on this security? What will be the required return? It will be, can I say, 9.6% for the similar companies? Right? So we say it's 9.6% for similar companies. And to that, you're going to add 1.09% and also 0.36%. So total it up. How much is this total?
11.05.
11.05%.
5%.
That's the required return that we want, right? Okay, so that's the required return which we have. Now, required return, I need to obviously get the yield or income on equity shares. So income on equity shares, because they're saying that income on equity shares or yield on equity shares is calculated as 50% of profits distributed and 5% of undistributed profits. Okay, so income on equity shares or yield on equity shares is going to be considered to be, it's going to be 50% of profits distributed plus 5% of undistributed profits. So 50% of distributed profits is 6,40,000 into 50% plus what was the undistributed profit? 6,20,800. 6,20,800 into 5%. So what is this number, guys? Tell me. Yep. What's this number?
3,51,040. 3,51,040.
3,51,040. Right. So here this has 3,51,040. So value of the equity share will be simply income upon the required return. So income is 3,51,040 upon the required return is 0.1105. Okay. How much is this? 3,51,040 divided by 0.1105. How much is this number?
31,76,830.
31,76,000.
Yeah. 76,832.58.
Is it? Let me just check. 351,040 divided by 0.1105.
Yes, sir. 31 lakhs.
76,833.
3.
Okay. Then the question asks us value per equity share. So value of each equity share will be 31,76,833 divided by each equity share. How many equity shares are there? 8,000? No, 80,000. Yeah, 80,000
Yes,
shares.
80,000.
Value of each of the equity shares. 31,76,833 divided by 80,000.
39.71.
39.71. Yeah. That's the value of the equity share. Easy?
Easy, but it's in a lot of conceptual framework.
So you need to know what is interest and preference dividend coverage from your CA Inter. You need to know what's the capital gearing ratio.
Yes,
You
sir.
need to add back the risk premium to arrive at the required return. And then you do the yield upon the required return. Okay.
By revising this question, we will gain all the concept.
So all your concepts are tested over here. Okay, so 7th is done, 8th is done. And now we have 9th question. Yeah, let's go with the 9th question now. And anyways, 10th is done, right? 10th is done, right? Yes. 10th is done. Then we have 11, 12, 13th also to be done. 14th, 15th is there to be done. Yes. A lot of things to do. Okay. Anyways, let's go for question number 9 now. Guys. A company pays a dividend of 2 per share with a growth rate of 7%. And here we have the risk-free rate as 9%. And the market rate of return is 13%. The company has a beta factor of 1.5. However, due to decision of financial manager, beta is likely to increase to 1.75. So we have to find out the present as well as likely value of the share. So there are two situations. One is what we call as the present, and the other is the likely. So company pays a dividend. Okay. When you say that it pays a dividend, obviously it has paid. So you can say it is D0 is 2. Growth rate is 7%, or we can write it as 0.07. Okay, and in the likely situation, also the D0 is 2. And over here, the market rate of return is 13%. The risk-free rate is 9%. Beta is 1.5. Okay, so growth rate is again 0.07. RM is 13. RF is 9. And we just have the beta to be changing to 1.75. So under both the situations, first we need to get the KE. Okay. We can get the value of KE first. After KE, you have to apply the formula of P0, which will be D1 upon KE minus G. So D1 is D0 into 1 plus G upon KE minus G. So we have P0 equal to D1 upon K minus G, which is D0 into 1 plus G upon K minus G. So can we calculate both of these values, guys? Can we calculate the price of the share in both situations over here? Yes.
This K is, in first case, K is 15%. In second case, it is 16%.
So K will be over here, it will be 9% plus 1.5 into 13% minus 9%, which is 4 into 1.5, 6, 9 plus 6, 15%. Then this is 9% plus 1.75 into 13% minus 9%. So 9% plus 1.75 into 4%. So how much is this?
Sir, for 26.75.
Second case, 26.75.
First case is 26.75.
No, you're talking of price.
I'm talking about price, sir.
Okay, so 2 into 1.07 upon 0.15 minus 0.07. So this is 26.75.
75.
Yeah, 75.
Okay. Then
K
this
in
one,
second case is 16%.
16%. Perfect. So this is going to be 2 into 1.07 upon 16% minus 7%. So what is this? Yep. 2 into 1.07 divided by 0.09.
23.77.
23.78.
78.
Okay. You can see as the risk increases, the price of the share goes down because of the higher required rate of return. Okay, so that's question 9. Easy. 10th is done. Okay, now question 11. Question number 11. Shares of Voyage Limited are being quoted at a price to earning ratio of 8 times. The company retains rupees 5 per share, which is 45% of earnings per share. You're required to compute the cost of equity if the market expects a growth rate of 15%. If the anticipated growth rate is 16%, what will be the indicator market price of the same cost of capital? And if the company's cost of capital is 20% and anticipated growth is 19%, calculate the market price per share. Okay. So can we just do it? Can we solve it? Yes, everyone? Can I do it? I'll just give you a couple of minutes to solve it. Just give me one couple of minutes, yes, I'll be back. Till then, just try out this question 11. Just give me a minute's time, guys. Till that time, just try out this question 11 quickly. Okay. Okay. So question 11, guys. Shares of Voyage Limited are being quoted at a P ratio of 8 times. So we have the P ratio of 8. Company retains 5 per share, which is 45% of EPS. Okay, so if the retention is 5 per share and it is 45% of EPS, right? So we can definitely get the EPS value, right? We have retained earnings. So how much is the value of the retained earnings?
5 rupees per share.
Right. And retention ratio is 45%. So if retention ratio is 45%, what is EPS? 5
55.
divided by 45%?
Yes, sir.
11.12.
11.11. Okay. Now, of course, the dividend per share will be 11.11 minus 5, which is
6.11.
right? Okay, so EPS, we've got the DPS. Now the market price per share, or P0, since it's a P ratio is 8 times, it is going to be EPS into P ratio. So EPS is 11.11 into the P ratio given to be 8. So answer will be 88.89. That's the market price per share, 88.89. Okay. Cost of equity, if the market expects a growth rate of 15% now. So you want the KE value. So KE, it is going to be D1 upon P0 plus G. So D1 is 6.11. Okay, so company retains 5 per share, which is 45% of earnings per share. So now here I am taking this as, of course, D1, assuming that it's for the future one. You can also alternatively say with an assumption that this is the D0 also. So you'll get the marks for that. Don't worry about that. Okay. So it is 6.11 upon P0. So price is what we got as 88.89 plus a growth rate. So growth rate is
15%.
15%. Okay. 0.15. So what is this K? Given the value of this K, guys?
21.87.
21.87. That's your K. Okay. Now, second part. If the anticipated growth is 16%, calculate the indicative market price at the same cost of capital. Okay. So now for the second part, we want P0. Now P0 will be D1 upon K minus G. Okay. So that's D1 is going to be like 6.11. However, the growth rate is changing because we are saying that you keep the K constant and the growth rate is 0.16. Yeah, so that's 6.11 divided by 0.2187 minus 0.16. So how much is this number? $6.11. Okay. 0.2187 minus 0.16. That's 0.587 into 6.11. So it's 104.08. Just check, guys.
Yes, 104.09.
09. Okay. Third part. If the company's cost of capital is 20%, anticipated growth rate is 19%, then calculate the market price. Now it is pretty simple. It's going to be D1 upon same K minus G. So this is 6.11 upon 20% is the cost of capital and 0.19. 19% is the growth rate. So the value of the share is 611. Easy? Clear, everyone? Mm-hmm.
Yes, sir.
Yeah. Okay. Now, let's go for this is 11th is done.
इसमें D1 में 1+G क्यों नहीं किया हमने?
We are saying that whatever is the dividend given over here, I'm assuming it to be like for the next year. Company retains 5A. You can also do 1+G assumption. So both ways are acceptable. No, don't worry about that part. Because I didn't do it because there are multiple numbers we have to use, right? The same D1 is going to dividend is going to use for 3 times. So every time I need not calculate a different dividend. So therefore we are saying let's keep the dividend as a constant. Or else you can also add the growth rate also. There's no issue in that. Okay. Now, question number 12. Yeah. Question number 12. We have to prepare the income statement. Calculate the sustainable growth rate. So what do you mean by sustainable growth rate? It is simply B into R, which is the retention ratio and return on equity. Fair price using dividend discount model. And what's your opinion? So opinion will do it later. But I think these 3 things you can do it easily. Correct? Can we do it? Let me just put up the entire question. Okay. So this is the data that we have and what are we supposed to calculate? Look at this. So we have the debentures, bonds, equity shares, reserves and surplus, assets, asset turnover, effective interest rate, operating margin, dividend payout. So first you have to calculate, obtain the income statement, then get the sustainable growth rate as retention ratio into return on equity, and then calculate the fair price using dividend discount model. Okay. So would you like to give it a try, guys? Or you want me to solve it? Will you solve it? Will you give it a try? Yeah. Or shall I solve it fully? Hello.
Yes, sir. We will solve it together, sir.
Solve it together. Okay. Fine. So let's just prepare the income statement over here. For that, I'll do one thing. I'll give you the format of income statement. Can you just fill it up with numbers?
Yes, sir. Sure.
Okay. So I'll just give the income statement this side. So you start with sales. Okay. Then you subtract the operating expense, which will give you EBIT. From that, you're going to subtract the interest, which will give you PBT. From that, you will subtract the tax, which will give you profit after tax. Okay. And then you subtract the, do we have the preference share over here? No. So you have equity dividend, right? And then you have the retained earnings. Okay. So this further subtracted, further subtracted, further subtracted. I think this is something that you should be able to do it. Okay, try to get this. I'll just give you a couple of minutes for this. Okay, how much is the sales, guys?
660.
Because you have total
660.
assets and asset turnover given to us, right?
Yes, sir.
Yes.
It is
660.
600 into 1.1, which is 660. Operating expense. That is something which we don't have information. But yes, we have the operating margin as 10%. Now, if your operating margin is 10%, it is going to be
594.
10% of 660, right? So this is 66. Of course,
66.
operating expense will be balancing figure.
594.
66 minus 660 minus 66, which is
94.
594. Interest is
15. 15.
15.
15.
125 into 10, and
125
also
into 8.
10 into 15.
125 into 8.
Sorry,
Plus
125
50
into
into
8
10.
plus 10% of 5.
Yes.
50. 10% of 50 is
10% of 50 is 5.
how much is this?
Total is 15.
125 into 8% is 10 plus 550. But here you can do that, but there is information given over here. See, effective interest rate is 8%. So basically, the IRR or the effective rate of interest that you're paying is 8%. So interest is not something which is going to be on this. So I need to look at the effective interest rate. Effective interest rate is taking into account the redemption value and the premium on redemption or discount on issue. All those things are taken account, and you have the effective interest rate, which is a blanket rate for both of them. Okay, so therefore it's going to be simply 175 into
14.
8%. Yes, it's just going to be 14. Had it been a case that there's no effective interest rate given to us, then you can definitely do what we have already thought about. So PBT is how much, guys? 66 minus 14.
52.
No. Tax rate 40%.
40%.
So 52 minus 20.8.
31.2.
31.2. Equity dividend is
Sir, why we haven't taken 10% interest on one?
10% because you have been given effective interest rate of 8%.
Okay,
This is
sir.
the combined rate of interest applicable on both of them using the
Okay.
IRR method, effective yield or effective rate of interest method.
Okay.
So 31.2, and what's the equity dividend we are paying? Dividend payout is 16.67%. So 31.2 into 16.67%. 5.2.
5.2.
Yes, sir.
So retained earnings is 31.2 minus 5.2. 26. Right. So this is the income statement that we have. Now calculating the sustainable growth rate. So the growth rate is B into R. So B, or the retention ratio, is going to be 1 minus 0.1667 into what's the return on investment that the company has? Return on
15.
equity.
15%.
No, that's the return on investor which the investor require. What's the return on equity that the company is generating? Return on equity which the company is generating. It is like you are having a PAT of 31.2, right? Upon a net worth of this total. So you are essentially earning 31.2 on a net worth of 400, which is 100 plus 300, 400. So 31.2 divided by 400, right? And then this multiplied by 0.833333. So 6.5%.
Yes, sir. 6.49.
6.499. So it's like 6.5% is the growth rate that we have. So that's a sustainable growth rate. Now fair price of the share using dividend discount model. So P0 will be D1 upon KE minus G. So D1 will be what's the equity dividend paid out, which is 5.2, because this is obviously with regards to the year 2008. So all this dividend have been paid in the current year. So it is 5.2. On that, we'll need to add a growth rate of 1.0. Yeah.
सर ये इक्विटी डिविडेंड निकाला है तो ये 16.61% इक्विटी कैपिटल का आना चाहिए ना
नहीं, डिविडेंड पे आउट बोला ना बेटा यहाँ पे. दिस इज नॉट डिविडेंड रेट, दिस इज डिविडेंड पे आउट रेशियो.
वही अर्निंग्स का होगा ना आपका तो
अर्निंग्स का होगा ना. पे आउट रेशियो विल ऑलवेज हैव अ परसेंटेज ऑफ अर्निंग्स. Cost of equity upon cost of equity is required rate of return for investor is given 15% and growth rate of 0.065. You just get this number. What is this price? What is this answer? Price?
65.15.
Sorry?
65.15.
65.15. No, there's some problem, I think. Equity dividend, sorry, we can't take 5.2 because I need to take each share, right? So it is 5.2 divided by the number of shares. So number of shares is 10. So 5.2 divided by 10 into 1.065. This divided by 0.085, which is 6.52. So if it is 6.52, can you tell me what is your opinion regarding the price of the share? Is it overvalued or undervalued?
It's overvalued.
Price is
40.
400. So this is definitely overvalued. Correct this? Got it?
Yes, sir.
Yep, so that's overvalued. Okay, so this was question number 12th. So 12th is done. We're done 11, 12. Now let's go for 13th question. Just see if you can solve it quickly. Question 13, guys. It has paid a dividend of 2.5 per share on face value of 10 in the financial year. The details are given. Current market price, growth rate of dividend and earnings, beta, average market return, and risk-free rate of return. You have to calculate the intrinsic value of the share. So over here, what will be the dividend? So intrinsic value, we can get it using the Gordon formula only. Okay. So over here, what's the intrinsic values? For that intrinsic value, we've been given D0 as 2.5. Right. So D0 is 2.5. Then we have the growth rate given as 10%. RM is 15%. RF is 9%. And beta is 0.75. So we can say cost of equity is RF plus beta into RM minus RF. So RF is 9% plus beta is 0.75 into 15% minus, sorry, RF is 9%. (15 minus 9, which is 6 into 0.75. 4.5 plus 9, which is 13.5%. Right, so K is 13.5%. We can definitely calculate the price as D1 upon K minus G. So D1 is like 2.5 is the dividend that you have paid right now. So 2.5 into 1.0, 1.1, the growth rate is 1.1 upon 0.135 minus 0.1. Yeah, so what's the price?
78.57.
17.
78.
78.57.
78.57.
0.57. Okay, so is the share price undervalued or overvalued in the market?
It's PO is 60.
Undervalued, right?
It's undervalued, sir. PO is
Undervalued.
60.
So we should buy the share.
Yes, sir.
Okay. Easy question. Then. Question number 14 now. Mr. A is thinking of buying shares of rupees 500 each, having a face value of rupees 100. He is expecting a bonus in the ratio of 1:5 during the 4th year. So the bonus that is expected is 1:5 in the 4th year. Okay. And one second. Anyways, okay. So 500 each, having a face value of 100, expecting a bonus of 1:5. 1:5 means one bonus share for every 5 shares. During the 4th year, annual expected dividend is 20%, and the same rate is expected to maintain on the expanded capital base. So expected dividend is 20%, it's going to be 20% of the face value. He intends to sell the shares at the end of 7th year at an expected price of 900. Incidental expenses of purchase on sale of shares is 5% of market price, and he expects a minimum return of 12%. Should Mr. A buy the share? If so, what maximum price should he be ready to pay for each share, assuming no tax on dividend and capital gain? Okay, so what we need to do is simply take the present value of all the future cash flows. Okay, so let's write down the benefits that we are going to get. So here, number of equity shares, right? And then we talk of the dividend, or rather we'll say particulars, and then cash flows. So in year 1, 2, 3, because the dividend is going to be 20%. So we can definitely say that over here, sir, year 1 to For how many years? Bonus is expected during the fourth year. Okay. So from
4
year
years.
1 to 3, you will just have, let's say, one share. You'll have just one share, and you're going to get dividend. What will be the amount of dividend, sir? 20 rupees. How did you get that 20 rupees, sir? Because it is 20% of the face value of 100. Right? And then from year 4, when are we supposed to sell this share?
7th year.
7th year. Okay. So year 4, 5, 6, and 7. Here you have number of equity shares now as 1.2. Now, why did we make this the number of equity shares as 1.2? Because you're going to get a dividend of 1:5. Sorry, bonus of 1:5. So when you say bonus of 1:5, one share for every 5 shares you're holding. So for every one share that you're holding, you're going to get 0.2 as a bonus shares. So here again, we're talking of dividend, but what will be the dividend that will be getting from they'll be getting in 4, 5, 6, and 7 years? What will be the dividend that will be getting?
Including that bonus shares.
Yes, now you have 1.2 shares.
24 rupees.
24. Right. Also, in 7th year, for this 1.2 shares, you're going to sell. What's the sale price given?
900 rupees.
So 900 into 1.2. 900 into 1.2. What is the sale value?
1080.
1080. Okay. Then we need to take the present value factor at 12%. Right. And then we take the PV. But wait, they're also saying that 5% of the market price is going to be incidental expenses. So when you say sale price, it's not going to be 1080. This is going to be into 95%. Why 95%, guys?
Yeah, 5% brokerage.
5% expenses, let's go.
5% is your expense. So we have 1026. Okay. So just take the present value, take the PV of it, discount it at 12%, and give me the PV value.
$563.98.
563. No,
Yes,
seems to be a very large number. Doesn't seem to be that way. 1 divided by 1.12 equal to
171.34.
Six six 4.69.
664. Baba re Baba. Two, three. So इसका PV factor is, the first PV factor is what, 2.4018. Then we have 1 divided by 1.12, first, second, third. Fourth year it is 0.6355. Then it is 0.5674. Then it is 0.5066. 0.4523. And this is also 0.4523. Now multiply them and give me the total. Okay. If we add all of them, what's the present value? If you add them all, what's the present value?
same 563.98.
Okay, 563.98. That's the share price. Now that this is the present value that you are having, right? This is the present value that you're having. But when I'm going to buy the share, I'm also going to pay 5% as the incidental expenses, as the transaction expenses. So what is the price that I'll be ready to pay? This is the price that I'm going to pay, maximum price that I can pay. But then max price of the share. Of course, this 563.98 is the total that I can pay. The price of the share should
It comes
be,
to
of course,
592,
sorry.
592.18 after adding
No.
5%.
Because when you're buying, you need to pay additional, right?
Yes, I'm adding.
525.
So you can say max price of the share is X. And therefore, we say X into 1.05 should be 563.98. Because after accounting for all the expenses, you should cover this. So this is nothing but 563.98 divided by 1.05. 63.98. Right. So that's 537.12. This is the maximum price that you can be ready to pay. Because if you are agreeing to the price of 537.12, then the total amount that you will pay with incidental expenses is 563. And that will ensure that you're earning 12%. Are we good, everyone? Got it? Did you get it, everyone?
Yes, sir.
Yes, sir. Yes, sir. Got it, sir.
Fine. So then let's take a break, guys. A break of around 10-15 minutes, and we'll be back with the remaining questions on cost of, the equity valuation. And post that, we will start to have some amount of MCQ discussion also. Okay, so let's just take a break, guys. All there? Okay, so we did this question number 14. Now let us go for question number 16, guys. Let's take up this question 16 for our discussion. Sam Limited has just paid a dividend of rupees 2 per share, and it is expected to grow at 6% per annum after paying dividend. So this company Sam is paying a dividend of rupees 2 per share, and it is expected to grow at 6% per annum after paying dividend. The board declared to take up a project by retaining the next 3 annual dividends. Okay, so it has paid a dividend of 2 and is supposed to be growing at 6%, but after paying dividend, board said that we are not going to we are going to retain the next 3 annual dividend. It is expected that this project is of same risk as the existing project. So it's going to take up a new project by retaining the next 3 dividends. The result of the project will start coming from the 4th year onwards from now. The dividends will then be 2.5 per share, and which will grow at 7% per annum. An investor who is holding this 1,000 shares and wants a receipt of at least rupees 10,000 per annum from this investment. So this investor requires 2,000 as the receipt. So show the market value of the share is affected by the decision of the board. Also show as to how the investor can maintain his target receipt. So let's first look at the initial part, how the market price is changing due to the decision of the board. So first, let us talk of what is the value of the share at present. Value of share at present. So that will be simply by taking D1 upon K minus G. Right. So D1 is of course going to be growth rate that will be added to the dividend. So that's going to be 2 into 1.06 upon K. Cost of capital of the firm is going to be 0.08 minus 0.06. So what's the value of the share at present? What is the value of the share at present? Yeah.
So rupees 106.
106. Okay.
106.
106. Okay. Now we need to also see what will be the value of the share if board's recommendation is implemented. Value of share if board decision is implemented. So what will be the value of the share if the decision of the board is implemented? Okay. So we need to get the value of the share if the decision of the board is going to be implemented. So therefore here we say that there won't be any dividend for the next 3 years. So I can definitely get the value of the share in year 3. Value of the share in year 3 will be D4 upon K minus G. Now what is D4? D4 is 2.5, right? Because they say if you are retaining it, we'll start giving out dividend 2.5 every year, and that's going to grow at 7%. So 2.5 divided by cost of equity is 0.08 minus 0.07. So 2.5 divided by 0.01. So the share price is 250. But remember, this is the share price in year 3. So I need to get the value of the share today. Value of share today. Since we don't have any dividend in between, I can definitely say this is value 3 divided by 1.08 raised to 3. So that's divided by 1.08 raised to 3, which is 1.2597. And this is 250 divided by 1.2597, which is 198.46. 198.46. So value of share today is 198.46. Okay. So this is the value of the share that we have. So we can see market value of the share is affected by the decision. Of course, due to the decision of the board, the market price is definitely increasing. Now we have this investor who is holding 1,000 shares, and he definitely needs 2,000 as a cash flow every year. Now the company is definitely not going to pay any amount of dividend, right? So company is not going to pay any amount of dividend, but he wants a receipt of 2,000, at least 2,000. Now earlier the dividend was 2, so 2 into 1,000 shares, he was very much comfortably getting that cash flow of 2,000. But now, since for the next 3 years there's not going to be any dividend, how is this targeted receipt be maintained? How can the investor ensure that he keeps on receiving that 2,000 rupees for next 3 years? Because from 4th year onwards, there's no problem. Because from 4th year onwards, your dividend is going to come in 2.5 per share. But during this intermediate 3 years, that is year 1, 2, and 3, how do we ensure that dividends start flowing to us?
He will sell some shares.
Yes, the only option to maintain that level of cash flow is to sell the number of shares, sell certain number of shares, right? Now, of course, we need to know at what price I will be selling the shares, right? I need to know at what price I'll be selling the shares, because when I'm selling the shares in year 1, I need to know what's the price of the share in year 1. If I'm going to sell the share in year 2, I need to know what's the price of the share in year 2. And same way, I need to know what's the share price after 3 years, right? So we'll have to compute the price of the share. So we have the value of the share today. What will be the price of the share in year 1? Price of share in year 1. What is the price of the share in year 1? Can I say it's going to be value in year 3 upon 1.08, but it will be raised to 2, right? So price in year 3 divided by 1.08 raised to 2. So this is 250 upon 1.08 square. So 250 divided by 1.08 square, which is 1.1664. 250 divided by 1.1664. 214.33. Right? What will be the price of share in year 2? Can you tell me how do I calculate this? Price of the share in year 2. How do I get the price of the share in year 2?
V3 upon 1.08.
Perfect. So it's going to be discounted by just a year. V3 divided by 1.08, which is 250 upon 1.08. 250 divided by 1.08, which is 231.48. Okay. So value of share today is 198.46. Value of share in year 1 is 214.33. Value of share in year 2 is 231.48. Okay. So I need to know how many shares I'll be required to sell to maintain that targeted cash flow. So number of shares to be sold by investor to maintain target cash flows. Okay, so in year one, how many shares should I be selling? I need a cash flow of 2000, and in year one, each share is priced at 214.33. So 2000 divided by 214.33, which is 9.33 shares. Okay, obviously I can't sell 9.33 shares. I'll have to sell 10 shares. Right? Then second year, it's going to be again, I want 2000, but each of the share is selling at 231.48. So 2000 divided by 231.48, which is 8.64. So how many shares should I be selling?
9 shares.
9 shares. Perfect. Then in year 3, to maintain my level of cash flow, this 2000 will be divided by 250. So we are going to sell 8 shares. Right? So we'll talk of year, particulars, and the cash flows that are happening. So in year 1, in the first year, we have sale of shares. 10 shares were sold at a price of 214.33. So you get 2143.3. Second year, again it is sale of shares, but now it is 9 into 231.48. So how much is 9 into 231.48? Which is 2083.32. Right? Third year, again sale of shares is happening. 8 shares at a price of 250, which is 2000. अच्छा, year 4 में अब क्या होगा? Now you will start receiving dividend. But you will receive dividend on how many shares now is? You are going to get a dividend of rupees 2.5. But on how many shares are you going to get dividend now? Are you going to get dividend on the original 1000 shares that you were holding? Of course not.
973 shares.
Yeah, because out of 1000, you first sold 10, then you sold 9, then you sold 8. So 2.5 into 973. How much is the amount of dividend? Is it within 2000? I mean, is it around that 2000 or less than that?
2,432 rupees 50 paise.
2,432. Okay, so this is anyways above our targeted cash flow. So that's way you can sustain that particular level of cash flows. Easy, guys?
Yes, sir.
Yeah. Okay. Okay, let's do this question number 15. And then we'll go for the MCQ part. The risk-free rate of return is 9%. The expected rate of return on a market portfolio is 13%. Expected rate of growth for dividend is 7%. The last dividend it was paid was 2. Beta is 1.2. What is the equilibrium price of the equity stock of Platinum Limited? Can you give me a quick answer for this, guys? Can you quickly give me answer for this? Can you just give me a quick answer for this? All the information is given in the question. You just need to substitute it. Yep. What's the answer? So it will be like 2 into 1.07 upon KE is how much?
13.8, sir.
13.80.
KE. Are you talking of KE?
Yes, sir. KE.
13.80. So it's 0.138 minus 0.07. %8 minus 0.07.
31.47.
31.47.
31.47.
Perfect. Easy. Now, how does the equilibrium price change when the inflation premium increases by 2%, expected growth rate increases by 3%, and beta is 1.3? So now we have different numbers. So we have like the inflation premium is 2%. So now the KE, which was 13.8%, to that you will add another 2%. This is 15.8%. Right? Growth rate is increases by 3%. So it's already growth rate was already 7%. To that you add 3%, so which will be 10%. And then we have the beta as 1.3. Beta is 1.3. Now, if beta is 1.3, I cannot take this K directly over here. Listen. The inflation premium is 2%. So your risk-free rate or market rate of return is going to be now 13% plus 2% because you'll need 2% extra return. So RM is now 12%, right? And RF is of course 9%. So we can get the new KE. KE will be 9% plus 1.3 into 15% minus 9%. So it's 9% plus 1.3 into 6%. 6 into 1.3, which is 7.8%.
16.8.
So this is 16.8%, right? So what will be the new price now?
So beta is 1.3.
Beta is 1.3.
1.3.
New beta. So it's after accounting for that, right? 15 minus 9, 6 into 1.3. Yeah, 7.8. Correct. So price will be now 2 into, now the growth rate is also different. 2 into 1.1 upon 0.168 minus 0.1. So how much is the price? How much is the price?
37.93.
37.93. Right, so that's the price, 37.93.
Sir, I lost the connection. That please explain how you got that beta 1.3.
Beta is given. Beta of platinum rises to 1.3. That is given in the question.
Okay, sir.
The second scenario, beta value is given as 1.3.
Okay, it is bottom of that. Okay, fine.
Yeah, it was there. Okay, so we're done 15th. We're done with 16th.
So the value should be 32.35.
This one.
Yes.
Okay, so it's something different. So it's 2.2 divided by 0.068. 32.35, correct. Okay.
Sir, what is the meaning here for equilibrium premium price?
Meaning for the
Equilibrium
price, the price which you will get by satisfying these particular numbers.
Okay.
Okay. Fine. Now let me just take you for some MCQ discussions. Okay, let's look at the MCQs. First one. Which of the following is a key assumption of dividend discount model? Which of these four options do you find that is a key assumption that we have in the DDM? Yep. The company has constant capital expenditure? No. Dividend discount model
Market
doesn't
value
say
of debt remains constant.
dividends grow at a variable rate forever? No. Investor receives dividends in perpetuity? Yes. This is the correct answer, guys, because here is what we say, or there's an underlying assumption that we make, that the investor is going to receive dividend till perpetuity, maybe at a constant rate or maybe at a growing rate. Okay, then question number 2. A company's dividend is expected to grow 5% indefinitely if the dividend just paid is 4 and the required rate of return is 10%. What's the intrinsic value of the stock using Gordon model?
80 rupees, sir.
80?
Yes, sir.
Remember, it's the dividend which has
84.
just been paid.
84.
It is just paid. So this 4 is D0.
The 84.
84 will be the answer, yes. Because you take D's 0 as 4, so D1 will be after adding a growth of 5%, then divided by 0.1 minus 0.05. Okay, third one. Which of the following valuation model is best suited for valuing a company that does not pay dividend and is in the growth phase? Which model are we going to use if you're not paying any dividend? Of course, if you're not paying any dividend, dividend discount model is discarded. Residual income is not something which is covered here. Net asset
value.
Net asset value method.
But even if you don't pay dividend, but you have free cash flow to equity, so FCFE model is going to be relevant. Okay, If a stock is trading at 150 and intrinsic value calculated using DDM is 130, what does this imply? The stock is undervalued, overvalued, fairly priced, or there's no implication?
Overvalued.
Overvaluation.
Right? The stock price is trading at 150. So
It's
stock
overvalued by 20 rupees.
overvalued by 20 rupees. Perfect.
Sir, we have to compare only with the market price, no? To check whether it is
Market
overvalued
price
or
with the intrinsic value.
yes.
Okay. Which of the following factors does not directly influence the price to earning ratio of the company?
Market capitalization.
Market capitalization, right? Because it's market price upon earnings. So whatever is the number of shares or market capitalization, that is not something which is going to be affecting, because growth prospects, obviously PE ratio will be higher because of greater confidence. Return on equity and PE are anyways inverse related. And dividend payout also, we can say earnings, whatever amount of dividend you are paying, that will have an impact on the growth. And because of that growth, your price may be something which may get affected. But whereas market capitalization, it's not going to be having any direct influence on the price earning of the company. Okay, so with that, we are towards the end of our today's session, guys. We have covered the equity valuation in these two sessions, like the previous one and today. Now from next class onwards, which we have it on Wednesday, we'll be taking up the bond valuation part. Okay, so which is a fixed income security valuation and other aspects of that. So we'll be taking them up in the upcoming session. Okay.
Okay. Student, if you have any query, you are free to ask here. Or otherwise, you can contact us at this number, or you can send me the email. Now, in today's session, Jagbantu sir has covered equity valuation, and free cash flow to the equity is very important, because nowadays more companies, or we can say more analysts, are giving insistence, or they are more relying on this free cash flow, because free cash flow is basically the cash flow that is accrued to the shareholders. Or we can say, because if we go by the formula or we by the logic, it is just simply the leftover cash after meeting the dividend, even dividend payout, and even meeting your capex, everything, whatever left. And now free cash flow is very important for the future growth as well. So now more and more questions have started coming in your examination. So but other topics are equally important. And in this class, as I told you earlier, D1 and D0 generally creates a confusion. Of course, D1 is dividend expected, D0 dividend paid, or last year dividend, etc. But if simple dividend has been given, so don't worry. You just is there any WhatsApp group for BUS? Okay, there is a group or a BUS. We will share. Are we allowed to share it? Okay, we will. There is a BUS group there app. We will share with you the number. Yeah? Ashok ji, just share the BUS group number. Link. Yes. And but my request to you, please, whatever your query, please send it through phone, or you can discuss with me over the telephone, or you can send it us through the email as well as mobile app, etc. So now in the next class, we shall take up the topic of bond valuation, because bond valuation nowadays is very important. As in India, even the bond market is grooming, and in a time to come, of course, this market is likely to have its own. It's likely to grow at very fast rate, because recently there was one news regarding bond index system is also there. So I think about 2 or 3 months after, our bonds will also be part of the consideration of the bond index. So this topic is very equally important. So in the next class, we shall take up the same topic. And thank you, Jagbantu sir, for sparing your precious time and enlightening the students. So students, revise whatever I have discussed in the class, and we shall take up the same next. We shall continue security valuation in the next class. So I think, Jagbantu sir, I think two classes shall be required for the same topic.
3, sir.
3. Okay. Okay. In the 3 top, this will be over. Okay.
Yeah, bond valuation.
Okay. Thank you, Jagbandu sir. Thank you.
Thank you.
Okay, student. Thank you and have a nice day.
Okay, thank you, sir.
Thank you.
Thank you, sir.
Thank you.